Ladies and gentlemen, good afternoon, and thank you for joining us today. Uh, Welcome to the M&S Masters Program and to the second webinar in this series. My name is Prasenjit Chakrabarti. I'm a partner in the corporate and M&A practice at Khetan & Co. And it is my real pleasure to moderate today's discussion. A very warm welcome to all of you, whether you are joining us from India or from elsewhere around the world. Our session today is titled 2025 Winners, Losers, and Lessons in M&A. And that framing is deliberate because 2025 was not a year of easy narratives. It rewarded discipline, punished excess optimism, and tested dealmakers on valuation, regulation, financing, and execution. The M&A Masters program is designed to provide experience-led discussion for senior corporate executives, in-house legal teams, investment bankers, intermediaries, and advisors involved in India-related M&A. Today's format is relatively straightforward, a short data presentation to anchor us in facts, followed by a moderated panel discussion, and then curated audience Q&A. Questions can be submitted through the webinar portal, and we will also follow up offline where required. As a matter of course, we will circulate the presentation materials, summary notes, and the recording of the webinar after we conclude. Just to set the stage, I think 2025 was a volatile year for global and Indian M&A, shaped by interest rate movements, geopolitics, regulatory evolution, and sharply divergent sectoral outcomes. Indian deal making rebalanced between control and minority transactions, plain acquisitions, and structured deals, and speed versus certainty. Regulators, including the Securities and Exchange Board of India, the Reserve Bank of India, and the Competition Commission of India, continue to refine frameworks affecting public M&A, competition clearance, foreign direct investment, and governance expectations. Today's discussion is therefore not about theory. It's about what actually worked, what struggled, and what deal makers should carry into 2026. Now, most of you would have already received a note on our panelist, so I won't repeat their credentials in detail. What matters is that each panelist here brings a distinct and complementary lens on data, execution, market narrative, and legal risks. Our esteemed panelists today are Anitesh Dharam, who is a business head of VC Circle and VC Edge, Shubhakant Bal, Managing Director of Rothschild and Company, Shaurav Majumdar, Editor-in-Chief at the Fortune India Group, and Ravindra Jhunjhunwala, Senior Partner at our Khetan's corporate team. So with that, I think let's begin. And I will hand over the stage first to Anitesh to really, I think, run through some of the data points, so that we can anchor ourselves in facts. Anitesh, over to you for a snapshot of India and global M&A activity in 2025.
Thank you, Prasenjit. Good afternoon, everyone. We can go to the opening slide. Good afternoon, everyone. So I'm Anitesh, and I head business for VC Circle and VCCH. VC is a data platform, so we basically are a day in and day out doing this. We track in private capital market, and we track all the activities in the Indian private capital market. And my role also today in this webinar, in the beginning, is basically is to anchor us on the hard facts, right? So we will just skip the conjecture, only talk about the hard facts. And next 10 minutes we'll spend on that. If you look at 2025 specifically, this was a year of distinct divergence. Global markets relied heavily on mega deals to stage a recovery. India demonstrated something far more robust, structural expansion on both value and volume terms. So we will look at all these, all majorly focus on India part. We'll just quickly also look at what happened globally in 2025. Please go to the next slide. Garima. Yeah. So let's look at the 4-year trend, zoom out on the 4-year trend. If you look at the global V-shaped recovery, we can really very clearly see the V-shaped recovery that global M&A landscape has seen. 2025 undoubtedly is a value rebound year globally, approximately $4.8 trillion of value, 36% jump in the value from the stabilization year we can call 2024 as a stabilization year and 2023 as the correction year post COVID. So there is a I would say perceptible change in the value growth that we see here. But what is to note here is that the recovery globally has been top heavy. I think around 75% of the growth that you see is driven by more than $5 billion deal segment. So it's a mega deal that is driving all across globally what is happening. On the contrary, after the luminous peak, I mean, the anomaly that we see in 2022 because of the SDFC merger, and that is why that number is so high in 2022. But let's look at correction year of 23, and then there is a slight recovery in 24 and now 25. Basically, India has moved from $40 billion market from the winters of 2023 to $44 billion in 2024, and finally a new breakout level we are seeing here. So unlike the global market, which has been very volatile, India trajectory has been of consistent structural deepening. We will slightly look at it in more detail in the next slide. What 2025 in India looks like. Garima, next slide, please. Yeah, so let's drill down here. So obviously on the value terms, we are seeing $60 billion of deal value, 36% growth, which is similar to what we see globally in terms of numbers. But what is very different here is the critical differentiator is the value, I mean, the volume terms. So globally, the volume was stagnant for last 2 years. I think there is a 5% growth that we see in volume terms. But in India, there is a 40% growth. It's equal to the value growth that we see. And which is a very important point to note, because this points to something very deep, very structural that is happening in the Indian M&A space. Around 1,000 deals, massive 41% growth, and this is the critical differentiator. So broad-based participation India has seen. We are not just seeing few large conglomerates buying assets. We are seeing deep mid-market where companies are aggressively consolidating to capture domestic consumption. This volume surge proves that 2025 wasn't just a lucky year, it is a year of broad market conviction. I think that is very important. And this was driven by few, I think, factors, the top level factors that we can see. Obviously, India is a consumption driven economy. That is one point. Regulatory arbitrage is also there. I think Prasanjit and Ravindra are better people to talk about that. But China plus one strategy is another aspect that is driving M&A in India. So these were the major drivers in India. Now, let's look at where these deals are happening in terms of sectoral heat map in the next slide, Garima. Yeah. So although we are seeing growth on both value and volume terms, or to the tune of 40%, but it's not broad-based. I mean, we can see a very clear K-shaped sectoral split. It's highly selective. So we witnessed a classic K-shaped sectoral performance. Clear winners, BFSI. This sector alone has contributed to around 26% in the total value terms, contributing around $15 billion in terms of value. And this wasn't routine M&As also. I mean, very different kind of M&A activity we have seen in BFSI, structural recapitalization, global giants returning to India, and also that too not for passive stakes, for substantial control stakes. Few deals we have seen, and in fact there are a few in pipeline as well, where global banks are taking controlling stake in Indian trade cycle. On the volume side, technology is one sector that is driving the volume part. I think around 125 deals have happened in the technology sector. But there also there is a shift in the thesis. In 2021, the value, I mean, the most of the M&A activities were happening to acquire the revenue, and that is what people were chasing. But this time it's very different. It's specifically to acquire engineering talent, AI stack, cloud infrastructure. That is why these M&A activities are happening now. On the flip side, if you look at the traditional sectors like chemical, traditional auto, there is a decline in the M&A activity there, mostly driven by global competition, some dumping pressure that is there, also the supply chain disruptions and fluctuations that are happening in the raw material cost and all. So that is the K-shaped sectoral heat map that we see here. In terms of valuation that we will see in the next slide, Garima. Yeah. So, I mean, India has always been a slightly expensive market compared to global peers, at least emerging market peers. And I mean, rationally so, if we can, being Indians, we can say that this is a rationally slightly expensive market. and we are seeing that we see that trend continuing around 15 to 25% premium compared to other emerging trends, and this is where the multiples lie. So if you look at tech and services, the asset traded at around 13 to 18x multiple, driven by scarcity of high value quality assets, and recurring revenue in tech is something that people chase. Healthcare and pharma also obviously driven by the economic landscape. These have seen high multiples. We saw industrial, auto, chemicals, these sector were slightly laggards, and their multiples have been lower. So this is on the valuation part, which has been slightly higher compared to the global emerging market peers. In fact, in the APAC region, I think India is the only country that has shown double-digit growth both on value and volume terms. There is no other country which has come close to this. So India is obviously, there are some structural improvements that we see here. Let's go to the next slide, Garima, and look at what kind of deals are happening. Now, this also is very interesting, and in fact, this is something also which is in kind of a divergence from how the general trend has been. This most significant trend in 2025 was the shift to control. Approximately 60 to 65% deal value came from control transactions. Now, there's a divergence from what has been the earlier trend. The days of global investors being comfortable with passive minority stakes are fading. Whether it is in the foreign banks entering India or a domestic conglomerate expanding, the mandate was clear. If we are deploying capital, we want the steering wheel. That's the mandate that people are going in M&A activity these days with. Also, I think on the PE front, institutionalization of platform strategy is also becoming popular now in India. I think that is also a very recent trend and very interesting trend to see. So instead of buying isolated assets, funds bought foundational assets like regional hospital chains, renewable energy portfolios, and use them to roll up smaller fragmented players, and that is also being seen. Also, there is a dominance of private to private kind of an M&A activity, accounting for nearly 75% of the volume. So that is also very interesting, where I think we see a lot of unorganized players getting organized through these kind of M&A activities. So very interesting trend in Indian M&A market. Next slide, Garima, please. Again, moving to the next important aspect of M&A, which is basically the capital movement. So this again is a very interesting and points to something very robust. If you see, almost all the numbers are on the similar lines: $20 billion effectively, outbound transaction 20 billion, inbound 20, domestic consolidation also around 20 billion. So this also is very interesting. So we are nearing parity in all these segments. Indian corporates are no longer just targets; they are active global consolidators. We saw Indian auto and tech majors utilizing strong balance sheet to acquire IPs, EV technologies, market access in Europe and US. Meanwhile, domestic consolidations remains the backbone of our volume. So majority of the volume that you see, smaller deals that are happening is basically domestic consolidation, that private to private consolidation that we saw. In fact, around 700 deals are in that segment. So three pillars, distinct pillars: structural, strong domestic churn, strategic inbound capital, and aggressive outbound acquisition creates a much stronger, resilient M&A ecosystem than what we had, say, probably a decade ago, right? We will look at a few transactions anonymized. Prasenjit told me that we should not use names. Next slide, please, Garima. So these are a few, these are real transactions, just anonymized in terms of number, but we all are aware of these transactions. So global bank acquiring 60% strategic bet that we are seeing. So immediate access to Indian retail credit is what people are, say global banks are looking at. So that's a $3 billion transaction. Outbound transaction, if you see, an Indian auto conglomerate acquiring European EV manufacturer for around $4.5 billion. And that is not buying a brand or not buying say revenue. It's just buying strategic chassis technology that they were looking for through this acquisition. And then domestic consolidation. This is a very interesting PSU transaction where I think two PSU came together to form a JV and then acquire an EV company. So I think these are the representative transactions, which gives you a flavor of what kind of inbound, outbound, and domestic consolidation we are seeing. Yeah. Next slide, Garima. Yeah, so this is the advisory landscape. This also is very interesting. So if you see, like in the capital front also, we are saying there is fight for Quality here also we very clearly see there is flight to quality. So advisory activity mirrored the market flight to quality thing. As transaction structures became more complex, say control, platformization of fees, corporate consolidated trust in market leaders, and here we see the names. So I mean, and then this is not staged. Even in our reports, you will see Khatan being the being the leader in legal advisory segment in terms of number of deals that they have delivered, and on the IB space, we see UI doing the biggest number of deals in 2025. Yeah. Next. So this is just a summary of what we already discussed. So proven that Indian M&A market is moved from recovery to strategic aggression. We saw a breakout here, $60 billion. I mean, got invested around 1,000 deals, money pivoting to credit, capability tech, and structurally we saw a definitive move from passive stakes to active control. So these are few very specific and interesting trends that we have seen. Probably our panels, and in those discussions we will basically deep dive more into the say why aspect of things. So this was just the hard numbers that we wanted to present. This is all, Prasanjit, from my side.
Thank you very much, Anitesh. That was extremely, I would say, insightful and very clear factual map for 2025. And a lighter note, very heartening to see Ketan feature in your presentation. So that was very heartening indeed. Uh, let's move from what happened to what this means in practice for deal makers. And I think we can take the slides off and invite the panelists for a discussion. So maybe, I start off with Anitesh, you first, since you just delivered a lot of facts for us to consume and the audience to consume. And maybe Shubhakanta, you can supplement Anitesh. So Anitesh, just stepping back from individual deals, some of them you talked about. What does the 2025 M&A data tells us about overall deal volume and value for India compared to the last 3 years?
Right. So these are very distinct years, right? So 21 and 22 were anonymous years because of the COVID, and then SDFC deal basically makes 2022 slightly. I mean, out of the, I mean, we cannot basically take that year as a base year. So 2023 is our correction year. That is where our base number lies, $40 billion. Then we saw it going to $44 billion in terms of value, and now it is around $60 billion. So there has been a structural growth in the number, in the value terms, in terms of the value of deal happening, which is more than 35% growth that we have seen in this year. So in terms of value, that is what is happening. In terms of volume also, I mean, there is a more than 40% growth, and which is very interesting trend, like we discussed also. This means that less than 5 billion, I think there are around 45% of the transactions are happening at around $5 million kind of a range. There is uptick in around less than sub $100 million range transaction. And this is a very interesting trend. This points to something very structural that is happening in the Indian private capital space as well, where smaller companies are basically consolidating, and also platformization as a strategy is being picked by private equity firms. So on the that is what we see in value and volume terms. Ticket size, like we discussed, so only 14 deals I think is above $1 billion value in India, which is very different from the global scenario. We discussed that around, I think 75% of the growth is driven by more than $5 billion transaction that's happening globally. So globally, what is happening basically is that these are not regular people coming and transacting or doing M&A transactions. These are, say, global giants, big global tech firms doing some very different kind of a strategic investment or M&A activity, which is basically driving the numbers globally, which is very different from how we are looking at things in India.
Right. Sure. Shubhakanta, you want to supplement Anitesh on this? You're on mute, Shubhakanta.
Sorry, my bad. Sorry, I was just saying, no, thank you, Prasanjit, for having me, and pleasure to be here, and good afternoon to everyone in the audience and to my co-panelists. So look, I think maybe just to add to what Anitesh said, I think I'd probably say sort of 2 or 3 additional points. Right? I think one is 2025 or probably also was one of those few years where we had strong M&A activity in addition to having a very active IPO market, right? Historically, we have typically seen sort of one of those two kind of being strong. Relatively rare do we have where both sort of private as well as public markets continue to register very strong activity. And this is especially, I would say, noteworthy given that we had a slow start last year. H1 was relatively slow in terms of capital market activity. We had tariff related uncertainty at least for a meaningful part of the year, and in general there it was, let's say, geo uncertainty in various parts of the world, right? So considering all of those aspects, I would say the fact that we had a active M&A market and an active public market is probably pretty impressive. I think the two or three trends I would say that we've seen, and some of these are probably not specific to 2025, is one, just domestic consolidation, right? I mean, that to me is probably one of the biggest drivers of M&A, which certainly wasn't the case sort of 10 years back, like Anitesh mentioned, right? I think it's very clear that local companies, whether it's family-owned companies, large conglomerates, etc., I think realize that acquisitions can be a useful tool as they think about entering new segments, expanding capabilities, accelerating growth, filling white spaces, and so on and so forth, right? So that's kind of one trend that we think is here to stay. I think the second is outbound M&A activity, right? And I think again, we've had historically outbound activity. So it's again not the first year that we had outbound activity, but I think what makes 2025 probably a bit different is the broad basing of that activity, right? What I mean by that is, it's not as if the outbound activity was specific to certain sectors. It wasn't specific to only large conglomerates or large players, but it's rather kind of getting essentially more ingrained across just a wider swathe of corporates, right? Which means that more people, generally speaking, are buying into the industrial rationale of looking at overseas markets as a useful tool when it comes to M&A, right? Whether again it is going up the value chain, acquiring certain technological capabilities, etc., etc. I think the third point I would say, to add to the three archetypes that Anitesh mentioned, right? And certainly as a firm, as Rothschild, we were involved in transaction in each of the three archetypes that he spoke about last year, which is domestic consolidation, outbound M&A, and inbound inbound strategic activity. I think the fourth archetype I would say is essentially overseas majors looking at partnerships, right, with local families, local companies as a way to leverage the India opportunity, right? It doesn't need to be sort of 100% acquisition on day one. There can be other ways to tap the India opportunity, in a slightly more nuanced manner, right? Which I think we are increasingly beginning to, I would see, and that is again spread across sectors. We have seen that in financial services, we have seen that in insurance, we have seen that in consumer. So again, it just seems like more people understand the benefits of, just having a strong local partner, as opposed to kind of do it all by themselves. So those are probably to me, some of the lessons of 2025.
Thank you, Shubhakanta and Andesh. I think that was an excellent market overview. And after, I think, having understood the market overview, the natural next, I think, question would be which sectors really were winners. So I think what we heard is that perhaps it was a different kind of a year where there were no prominent winners, but amongst those deals, whatever we have witnessed, maybe Anitesh, you first, and maybe Shaurav, you can supplement Anitesh on this one. Which sectors clearly outperformed in 2025, and what really drove that outperformance?
Right. So I think, I mean, from the sector perspective, the story is of credit and capability. So that is, I think, those are the two keywords that drove M&A in 2025. Like we also saw, BFSI was the value engine, contributed around 26% of the total deal value, around $15 billion of deal value happened there. And that is inbound strategic stake that global banks like, say, Emirates and BD, MUFG, these kind of global names are shifted from passive investing to taking significant, say, strategic minority or controlling stakes as well, 20 to 60% range to access the India credit cycle. So that is BFSI driving the value. Also, I think automotive also to some extent drove the value because of the global play, because of the outbound activity we saw there. So high value impact due to large outbounds that we saw there. Supply chain control, probably Indian OEMs aggressively acquiring European IPs, distribution networks, fast track EV transactions. So I think those are the themes in the automotive sector. So these two sectors probably were about value. Volume, I mean, and likely so, I think that's going to continue, is going to be driven by technology sector, and given the AI wave that we are seeing. So I think that is the trend that is going to continue. So I mean, volume driver is going to be the technology sector, and this is all about capability acquisition, right? So all the incumbents have to look about their survival. I mean, if we want to play it down. So unlike valuation driven deals, which we were seeing probably in 21, 22, where it was about acquiring more revenue, increasing the valuation. So 25, I think tech M&As are specifically driven to establish firms, AI capabilities, engineering, cloud infrastructure, data center capabilities, and modernize their stack. That was the theme probably in the tech sector. So these three tech sectors, probably Prasanjit, from my side, are to focus on.
Right, Anitesh. Shaurav, you want to supplement on this one?
Yeah, I would pretty much agree with Anitesh. Basically, I think from a journalist and observer's perspective, I mean, most of you are deal makers and deal experts, but from a journalist perspective, I think the outsized story from a journalist perspective has been the BFSI sector in terms of the size of the deals. Some of the deals which Anitesh mentioned, clearly outsized deals where foreign entities are taking big bets on Indian the banks and banking sector. So I think that is a function of the health of the overall financial sector having improved. Then there are there is also there was the internal NBFC deal also there's been which happened internally. But I think the point was that I think the bigger bet in terms of the banking sector was the big story. Second is, of course, the ITITES thing where gaps in terms of the AI capabilities, the cloud, have been sort of addressed in terms of the M&A activity, where people have actually gone out and looked for clearly where they wanted to fill the gaps. See, one big trend which one notices is that some of these deals are now very clearly focused deals. It's not earlier. I remember when we used to cover the big acquisitions in terms of scale, boldness, etc. In terms of outbounds also from Indian companies in the mid 2000s, for instance. Today the story is very different. It is very clearly in terms of outbounds where it makes sense, what is the kind of fit and gap it will address. I think that is very, very clearly the thing. And of course, then there is the internet and internet companies, internet first consumer companies, which are tech-driven tech companies. Overall, I probably talk about those in one bucket. So I think tech, IT, ITES, and of course the big BFSI sector is the other two stories which are very clearly relevant to me.
Excellent. I think so. I think that gives a great perspective of what worked, which sectors really are winning. But whenever we are winners, inevitably we have to talk about losers also. So if I may, I'll again start off with you, Shaurav, and maybe Shubhakant, I will invite you to supplement Shaurav. Now, which sectors actually disappointed or faced headwinds in 2025, and were these changes cyclical or structural in nature?
I think, again, what I found after speaking to some of the investment bankers, etc., I think they are a bit disappointed with the lack of activity in the EV space in terms of the number of deals having, come down, in terms of what the EV sector has faced in regulatorily, etc. And, this whole China imports, the confusion which arose because of that. And I think that has been one disappointing factor. Then I think Amitesh also mentioned the chemical sector has been one which did not do very well. But I think the story which, if you look at 2-3 years ago and now, the number of deals in terms of the EVs, the interest in terms of the EV story has declined because of some of the marquee names, if I may say so, having not performed that well. I think that's still playing out. And I think that's been one story which is pretty much disappointed the investment banking sector, if I may say so.
Yeah, I think Prasanjit, just to add, right? Maybe I'll answer it in two parts, right? I think more than sectors, I'd say, there are probably two areas where we saw, let's say lower than expected M&A deal volume, right? I think one was essentially, any sector or segment that was impacted, by trade, tariff related uncertainty, right? Where clearly, people essentially wanted to adopt a wait and watch approach, right? For example, there are certain industrial segments, B2B assets, or even B2C companies, but largely catering to the US market, right? Where those companies essentially had actual impact from a tariff perspective, which obviously meant that profitability, was hit, and that kind of was one, I would say, casualty, right? I think the second, I mean, even if you look at something like, let's say, pharma, for companies which are predominantly focused on the US market, while there was no actual imposition of tariff, just the uncertainty around what may happen meant that, there was sort of lower, let's say, deal volume, right? Again, only for companies which were, predominantly anchored, to the US market, right? I think the other area where perhaps we faced headwinds, and this is not a sector specific, I would say, observation, but assets where essentially earnings growth for one reason or the other was muted or disappointing, and which essentially meant that there was a meaningful sort of, bid-ask spread gap between buyers and sellers, right? And we have had certain sectors, in India as well, where for one reason or the other, the earnings growth was indeed a bit muted or has been a bit muted over the last sort of 4 to 5 quarters, right? Now, naturally, the seller view would be that, look, this is a temporary blip and nothing structural, and return, growth will return back. But as a buyer, when you're having to pay reasonably full valuation, it does kind of cause some, let's say, uncertainty, right? Or cautious, right? So that was the other, I would say, area. I think the third area maybe is, is certain segments, while Anitesh obviously mentioned that tech continued to be very strong momentum, and we certainly sort of see that. There are specific pockets of tech which, either perceived or real, there could be impact from an AI perspective, right? So certain spaces where there could be sort of AI headwinds, right? Where either you saw, again, cautiousness on the part of buyers to investors, or some contraction in terms of multiples that those assets could fetch versus what historically, perhaps they might have witnessed, right? So those were probably, I would say, some of the areas where saw some lower than expected outcome.
Yeah, no, I think that sets out why and which sectors didn't fare that well, and hopefully they will turn around in this year. And I think once sectors, diverge so sharply, valuation expectations inevitably follow. And therefore, the next theme we will touch upon in this discussion is valuation and structures. So maybe again, this time I start off with Shubhakant, and Anitesh, maybe you chime in. How did the valuation levels, and multiples behave in 2025, and where did price negotiations start to break down?
Sure. So maybe I'll answer, given there are two parts of your question, Prasanjit, maybe I'll answer it in two parts, right? So look, I think in terms of the first point, right, which is, how did valuation levels generally behave? I mean, look, in general, I would say for good quality assets and assets in defensive sectors, right, we've actually seen valuations go up over time, right? And I think that comes back to, I'd say, two or three, broad drivers, right? I think one is, clearly, there is a fair bit of investment flows, a lot of which is in the form of private equity capital, which is directed towards India, okay? And again, I'm sure a lot of your audience members would realize that, obviously we've got large Asia pools of capital that have been raised in the last 2, 3, 4, 5 years, a lot of which historically probably went to China, which is given the, the current sort of geo orientation, some of that is increasingly being channeled to India, right? Which essentially means that you've got more capital today, theoretically speaking, for India than what might have been the case in the past, number one. Number two, we've obviously seen a meaningful increase in interest from sovereign wealth funds and pension funds, right? A lot of which is from Middle Eastern funds, which is all directed towards India. And number three, like I mentioned earlier, we are seeing meaningful uptick in domestic M&A activity, which essentially means that if you put all the 3 points together, you've got more private equity capital, you've got more sovereign wealth, funds and pension funds wanting to invest in directly in India, and you've got more domestic, interest from strategics, right? All of this combines to result in greater competition, especially for high quality assets, right? And I would say there are a bunch of sectors where there is scarcity of actionable high quality assets. So a natural consequence of this phenomena is that for better assets you essentially have got pretty punchy valuations, right? I think what is also supporting this to an extent is just where public market valuations are, right? I mean, we've again seen in certain sectors public market valuations continue to be very, very attractive, and inevitably there is some reflective impact of that on private market deals, right? Where sellers expect some of that benefit to accrue to them even when they're transacting on the private side. So that's kind of in terms of where valuations, let's say, have been strong. I think to your second question, where negotiations were challenging, I mean, I would say probably 2 or 3 areas. I think one was, where, like I mentioned, the actual growth of the asset was muted, at least in the near term, which essentially meant that there was a meaningful bid-ask spread between buyers and sellers. That was clearly one where we saw clear issues around bridging the pricing gap. And again, we can talk about what structures, etc., we saw being adopted in the market as a result of those. I think the second was, where there are sizable assets which credibly have an option to either tap public market or, execute a private sale, where we saw that some of those assets which have the option of going either way shift a little bit towards public markets, just given the relative higher valuation in public markets, which again is not a new phenomenon, by the way. In 2025, we have generally had this over time in India, right, where assets which are large scaled up can tap into public markets, do want to exercise that optionality, right? So I think I'd say probably those were the 2 areas, thematically speaking, where we saw, let's say, greater challenges in bridging the price, the bid-ask spread between buyers and sellers.
Thanks, Shubhakant. Anitesh, you want to supplement to that?
Yeah, so I'm going to more focus on from the data perspective, but what we have seen that Indian assets have been generally compared to group, at least APAC peers, have been slightly on the more expensive side, and that we have seen continuing, right? Specifically in the tech space, tech and technology-driven spaces, that has continued this year as well. What I think on the valuation side, which was the negotiation, big negotiation point, I think one was on the growth trajectory, right? I mean, so sellers were projecting higher growth numbers, buyers were trying to say probably negotiate on those, and I think that was a big friction in terms of how the value the asset. I think, and probably you all will know better, I'm told that earnouts became a big feature this year in terms of, say, around 20% of the deals had earnout kind of a deal feature. So I think that probably we are hearing a lot, right? So I mean that growth expectations and what we are projecting, that is becoming one big talking point. I think also because of the cybersecurity, AI and other things. I mean, so the crawling structures in the market and everything is becoming very, very, riskier. So I think that intelligence also is becoming one important point where we are talking about cybersecurity, data risk, and those kind of stuff. So anything that comes up intelligence in those fronts is also pushing the valuation slightly last minute. It is becoming a challenge. So probably, you all are closer to the deals. So I think from that perspective, you can discuss. But this is what we are hearing and on from the data side that we see here.
Oh, interesting. I think both of you and I think Shubhakanta talked about valuation gaps. I think it's no secret that to bridge valuation gap in uncertain markets, deal makers often turn to structuring I mean, not to manufacture price, but to reallocate risk. So my question, maybe Shubhakanta, you first, and then I will request Rabindra to chime in. That what role uh, structuring tools like earnouts, deferred consideration, and rollover equity play in 2025, and did they actually work in practice?
Yeah, absolutely. So look, yes, we certainly saw both sort of earn-out deferred consideration as well as sort of, rollover equity, and probably I'll differentiate a little bit between those two, but we certainly saw both of these, instruments at play, right? I think the earn-out stroke deferred consideration, we saw work well, where I think to Anitesh's point, there was clearly a delta between the actual sort of growth delivered and sort of what sellers were projecting, for the near term, which, clearly there was an acceleration expected. And bidders were essentially unable to necessarily give value on day one, right? To say that, look, show me the proof of concept, let the growth play out, and then we are happy to, pay, right? We certainly saw that sort of, become a feature of certain deals. Now, look, inevitably, earn out or deferred consideration, works better where there is some degree of, let's say, alignment between the buyer and the seller, right? Because there are equally deals where we see, where there is a concern on either side, right? As to, while in theory you can have earn out or deferred consideration, whether there will be essentially a divergence, right? Of interest when it comes to sort of balancing short-term and medium-term priorities, and whether the earn-out or the deferred consideration will actually play out in reality, right? So you do need a degree of alignment sort of for these structures to help you to bridge it. And frankly, in at least in my experience, they can help you to bridge it within a delta, right? Beyond a certain delta, I'm not sure. I mean, there's only so much that you can solve using sort of deferred consideration or earn-out. I think the second instrument, right, which is the rollover equity that you spoke about, Prasanjit, I think that we have seen increasingly actually at play, and that's not just a feature of 2025. I mean, and that I say doesn't just stem from a valuation delta standpoint. I think that also stems from the more sort of broader theme, right, where we are seeing increasingly family-owned businesses, willing to cede control either to private equity buyout funds or to strategic partners, right? Either when, for example, there is a transition from first generation to second generation, or for example, when there is no succession, planning, when there is succession planning issues, etc., right? Where people are happy to essentially cede control, but not necessarily fully sell out, because the view is that there is still a lot of growth left to benefit from. There is still a lot of growth upside, where I think rollover can work pretty nicely. But again, I think the key there is then you need sort of appropriate minority protection rights, appropriate governance mechanisms in play, because inevitably then you've got two partners, one who is taking perhaps a 5, 10, 15-year view, the other one which may not have as long-term sort of viewpoint, right? So inevitably then you kind of get to some of the governance mechanisms that I'm sure Ravindra will speak about. But we certainly see in general rollover equity, families wanting to retain a minority stake after having ceding control increasingly become pretty common, across sectors, I would say.
Excellent. I think Ravindra, stage is set for you to now share the legal technical side of it as well.
Well, thank you very much. Completely agree with what Shubhakanto has said. There is no doubt that earnouts, deferred consideration, and rollover equity have been everywhere over the last few years. It's the uncertainty of the times which has clearly accelerated their use. It is important to remember one basic point at the outset. These are not valuation solutions, and Shubhakanto mentioned it as well. These are risk allocation tools, and they only work when risk is consciously and fairly allocated. Earnout role was straightforward. They were used to bridge valuation gaps by shifting post-closing performance risk to the seller. They have worked, but they have worked when it's been used with great discipline. Milestones had to be simple, short-dated, and objectively measurable. And where those where those metrics could survive the post-closing integration, The moment the buyer would try to take full operational control and still keep earnout optional, the structure started to crack. As you often say, you cannot have your cake and eat it too. Deferred consideration role was more functional. It was a cash flow and risk management tool for buyers. Again, selectively, it has worked. It has worked where it was short dated, it was time bound, it was properly secured through escrows or holdbacks. As soon as it ran beyond indemnity period or remained unsecured or became conditional in subjective ways, the sellers increasingly pushed back. And it's at that point the deferred consideration stops being a deal structuring mechanic and starts looking like an unsecured seller credit. Finally, coming to rollover equity, it played a very different role altogether. It was about alignment. Again, I'm repeating what Shubhakanta said, and it was making the seller stay invested in the upside. It's a classic second bite of the apple case. It has worked where the second bite was real. So rollover, the exit visibility has to be credible. The protections have to be meaningful, and the seller should not simply be swapping liquidity for permanent illiquidity. So as soon as the exit timelines were stretched or protections were illusory, promissory event never arrived, the rollover predictability became a source of friction. So the real takeaway is that market uncertainty has made these tools almost unavoidable in getting deals done, and they only succeed when they are used to genuinely align the incentive and the share risk. So used well, they help parties to bridge uncertainty and close deals for all of us. But used poorly, they simply defer the hard issues, and it's guarantee that there's a next dispute going to pop up.
Excellent. So I think that's a terrific recap of the use and value of earnouts, deferred consideration bit. I think moving on to, another interconnected topic is financing conditions and how does it impact structuring. So maybe Shubhakanta, if I can start off you, and maybe Saurav, you can supplement. How did financing conditions and interest rate dynamics influence deal structures and buyer behavior in 2025? You're on mute, Shubhakanta, sorry.
Sorry, my apologies. Hangover of the COVID era. No, so I was just saying that financing clearly is critical, right? I mean, it's in a way it's lifeblood for any sort of healthy M&A market. I think the good part about India, I would say, is that to a large extent, and in most parts, we are still a very much growth-driven market, which means that the use of financing is more to aid returns on top of what you can organically the business can generate, right? As opposed to certain assets in the Western market, which are predominantly financing driven, right? For example, the quantum of returns that you generate from financing in India is relatively lower versus what you would perhaps see in some of the Western market, right? Having said that, look, financing by and large was pretty healthy in India. Indian corporates in general have very healthy balance sheet, which are meaningfully under leveraged, right? Which essentially means that their ability to take on debt to finance acquisitions is pretty strong. On top of that, you've obviously got the multiple arbitrage, right, in the form of, let's say, listed market valuations in India versus where you can acquire assets in the West, which makes the financial economics even more, compelling, right? So I would say from a corporate M&A activity, by and large, it was very healthy, very healthy sort of environment. I think when it came to, let's say, owners, promoters using structured credit, right, over sort of, just plain equity, we saw that trend as well, sort of in a pretty meaningful way. And that I would say was probably more pronounced where, let's say, as a business owner, I feel that my organic growth in the business, right, will be higher than the cost of the structured instrument. Then there is a desire to sort of take structured instruments as opposed to plain equity, right, which is perhaps more dilutive on day one, right? So we've certainly seen sort of desire on the part of owners, promoters, companies to use structured instrument, as well as deepening of the structured credit pool market itself in India, right? Look, overall, I would summarize to say that financing continues to be pretty healthy in India. Balance sheets continue to be extremely healthy, in general under leveraged. So that by itself is an enabling factor from an India M&A standpoint, as opposed to really being any constraint. Plus, with the interest rate cycle easing, you would expect that to further act as an enabler for M&A going forward.
Excellent. Shaurabh, you want to chime in here?
Yes, I think I completely agree with the point Shubhakanto made. I mean, today, if you see versus what used to be there earlier, corporate balance sheets are a different story altogether. Corporates have cleaned up their act. Bank balance sheets are looking healthier. Corporate balance sheets have been cleaned up. So the time is actually ripe for interesting structured deals to also happen. Having said that, there's a lot of money also in many of the large corporates in their own bank accounts. So whether it is structured deals, whether it is their own funds, self-owned funds, there's a lot of money floating around for M&A. So I completely buy Shubhakanto's point that this year, I expect more and more such corporates to, sort of, and let me also add that the interest rate regime has now become much more benign than it used to be maybe a couple of years ago, as we have seen. And today it is much more predictable. I think my conversations with investment bankers also suggest that they've seen that there is a lot of predictability now. There is a lot of stability now on the interest rate side from the regulator. So therefore, I think overall the financing infrastructure, if you look at India, is very, very geared to have serious M&A activity going forward. And I'm particularly bullish about 2026 as well.
Yeah, so am I. No, I think absolutely that really gives a very, very good insight on the financing conditions and situation surrounding M&A. I think it's a perfect time actually from my perspective to transition from the commercial lens to now the regulatory risks, because even if the commercial terms are aligned, execution often came down to regulation and timing. And maybe this is perfect question for Rabindra, and maybe Anitesh, you can supplement. So which regulatory or policy developments in 2025 materially affected deal timelines and certainty?
So, I'll talk of a few, but what I would start with is by saying that certain sectoral regulations which have changed and dramatically changed, and it has had an immediate and a disruptive impact on deal viability and timelines. At the same time, across the broader market, a series of clarifications and a tougher enforcement posture has changed how parties approached the execution risk. So the combined effect was slower deals in the short term, but materially greater certainty for transactions that ultimately closed. The one big driver was foreign investment regulation, the RBI's clarification on deferred consideration and downstream investments by foreign-owned and controlled companies removed some long-standing ambiguity, and they also imposed discipline. Deal teams have had to structure within clearer boundaries on timing, pricing, and consideration mechanics. We'll talk about the second one more in detail later, but to me it was antitrust. The CCI's more active enforcement posture combined with greater scrutiny of minority and strategic investments have meant that parties could no longer treat competition approval as a back-end formality. Even deals that were ultimately non-problematic spent time in pre-filing analysis and market definition work and internal risk assessment. The third one I would want to leave you with is the labor codes, which were made effective November last year. Market is still playing catch up with the compliance rigor. The new regime has caused buyers to reassess workforce structures and employee-related liabilities much earlier in the process. Well, overall, the overlaying all of this is a clear shift in the regulatory mindset. the regulators across the board signaled a lower tolerance for technical non-compliance. That changed how lawyers and sponsors approached diligence, filings, and closing mechanics. So more issues were escalated early, more buffers were built into timelines, and fewer matters were left to be sorted out later. So I'm not going to go beyond the horizontal regulations and get into the sector changes, but there have been changes in the insurance space. We've also seen the online gaming space being restricted. The broader takeaway to me is that 2025 reinforced that regulatory risk is no longer a peripheral workstream. It is now central to deal making. Transactions that treated regulations as a front-end design issue moved faster and with greater certainty than those that treated it as a closing checklist item for a later stage. Prasanjit.
Thank you, Ravindra. Antesh, you want to come in with your insights on this as well?
Yeah, so obviously I'm not that integrated like you all into the legal frameworks of things, Prasanjit. But I mean, few things that I got to hear or I basically saw from the data perspective. One clear discussion was that regulations moved from say gatekeeping to market shaping. So I think that was a very clear discussions going on. So obviously there were short-term frictions, deal slowdowns, but long-term they were very, I would say, clear guidelines on which would which would speed up processes in the future. So on the friction point, if there was one key directive that led to a specific kind of a slowdown in the deal, which basically was the DBT guidelines by say CCI. So which basically, I mean, which tells that if there is a transaction of value greater than 2,000 crores, I mean, you require notifying if the target has substantial business operations in India, right? So that create a ambiguity for some time what business operations, I mean, say substantial business operations means and those kind of things. But I think those were short-term friction and short-term slowdowns. I think there is greater clarity there now. I think key accelerator was so fixed price delisting mandate. So primarily designed for PSUs, but probably I think that would give sponsors a better leverage if there is fixed price delisting. So I think these are the two things that I would want to highlight.
Thank you, Anitesh. I think let's just maybe 2-3 key questions we will take and then maybe move on to audience questions. I can see a flurry of questions coming in. Maybe Ravindra, first question to you, continuing on regulatory aspects is, but slightly shifting the lens, not as competition lawyers, but as deal practitioners. How did competition or antitrust review timelines affect larger or consolidating deals in 2025?
So I will start by clarifying that I'm not a competition lawyer. I'm a M&A lawyer. My perspective is more deal-making oriented. I will keep it short. I do see antitrust timelines the way deal teams do as something that determines whether your closing date is optimistic, realistic, or completely fictional. So now, if you look at the competition review timelines in India from both a global and domestic lens, the key point to appreciate is that the antitrust review in India rarely ever kills a deal, but it is very clearly shaping how long they take and how they are structured. In practical terms, the baseline timeline are fairly well understood. A form 1 filing will typically take about 6 to 8 weeks. Form 2 filing can run 8 to 12 weeks or longer, depending on the complexity of the matter and the information request. But again, importantly, the CCI has almost never outright denied an M&A approval. Where concerns have arisen, they have been addressed through conditions, whether behavioral remedies or structural adjustments, rather than a prohibition. So that makes India attractive as a relatively predictable jurisdiction from a global perspective, though not necessarily a fast one for complex deals. So what has changed in recent years is how early competition risk now needs to be addressed. The headline for the global audience is this, that India is not hostile. hostile antitrust jurisdiction, but it is a deliberate one. And for the domestic players, the message is equally clear. Competition approval is no longer a procedural step after signing. It's you need to front load it and plan it and get on with things. Prasanjit.
Thank you. I think despite your caveat, I think if somebody did not know you, Ravindra, you almost came across as a competition law expert on that. So well, that's a very good answer, which you just
Thanks
gave.
to our partners who feed me with good information. Prasanjit.
Oh yeah, of course, yes. So I think moving on, shifting gears to governance and minority protections, which are extremely integral to deal making. So maybe again, Ravindra, given slightly legal overlay of the nature of question, maybe you and then Shubhakanta can supplement. Uh, did expectations around governance and minority protections shift in 2025?
Absolutely, yes. 2025 demonstrated that these shifts were not abstract regulatory developments. They translated into very real transactional consequences that changed how deals were diligenced, structured, executed, and even disclosed. A clear structural inflection point was the mandatory dematerialization of shareholding in private companies. It's on the face of it, it was a digitization measure. In practice, it represented a governance reset. DMAT materially improves transparency, reduces risks around disputed title, informal pledges, and backdated transfers, and it just strengthens minority confidence. I'm not going to get into details of what and how the DMAT works, since we're running short on time. But the second shift, perhaps one more seen on the front page, is intensified scrutiny of related party transactions, and particularly in the context of group restructuring and slump sales. On the transactional front, we saw multiple large intra-group transfers of business undertakings, JV alignments, and restructuring of shareholding and pledge structures. These transactions frequently triggered shareholder approval and thereby invited proxy advisor scrutiny, which has intensified materially. In listed company transactions, this heightened governance sensitivity and also translated into greater discipline around disclosures. Your stock exchange filings demand specificity, accuracy, and comprehensive risk articulation, while press release requires clarity, positioning, and confidence building. If you look at the independent director role, that has noticeably moved to being a more active role in today's environment, whether the company is acting as a seller, target, or buyer. There was noticeable difference in role that the independent director played on the board as they stepped in, and they stepped in to interrogate much more than they would have done in the past. So it has increasingly moved beyond form to substance. So the takeaway for last year is that governance and minority protection have decisively shifted from being compliance driven to process driven. Transaction success increasingly depended not just on pricing and structure, but on whether governance, architecture, the disclosure discipline, and the board oversight could withstand the scrutiny. So in that sense, stronger governance has become an enabler of deal certainty rather than a constraint on it. Prasanjit.
Thank you, Ravindra. Shubhakanta, donning your investment banking hat, what's your take on this?
Yeah, sure. No, thanks. Ravindra. So look, I think maybe just to add to what Ravindra said, I mean, I couldn't agree more with everything that he said, right? Because for example, if you look at some of the, listed market, changes that he spoke about, right? The focus on, let's say RPT, the independent directors kind of, taking on a bigger role, a more active sort of role. I mean, that's especially relevant because, we are, seeing instances obviously of more global companies wanting to evaluate listing India businesses, which and some of them are not sort of used to, let's say, the nuances of Indian capital markets. Some of those nuances differ from how things operate in their home country, which essentially means that there is early preparation needed. They need to think through carefully what does it mean to go public in India from a regulatory standpoint, from a disclosure standpoint, etc. And early preparation is always helpful in these aspects. I think the second thing that we've also seen is, for example, when independent directors are being inducted, just on the eve of the company filing the DRHP, they are demanding that they get a bit more time because they don't want to just kind of come on board and then the company goes public, right? They want to have spent some time going through the documents. So I think clearly even independent directors recognize that they are being called upon and they need to take a more active sort of role, right? I think on the minority protection, Prasenjit, I would say that, and even governance, right? On the private side, I would say that the more instances we see of partnerships that we spoke about, whether it's a global major partnering with a local company, whether it is private equity partnering with a family-owned business, the more you kind of have need for institutionalized governance mechanisms in place, minority protection rights in place. Essentially, I think there is an ecosystem-wide greater focus on best practices, because we increasingly are going to face instances where there is going to be a multi-stakeholder, multi-shareholder context, right? Which by definition implies that we need to have proper governance mechanisms in place.
Right. No, thank you, Mo. That was very insightful. I think one last question before we go to the Q&A of audience members. I think key lesson for 2026. I mean, we have discussed in length what transpired in 2025, looked at data, structures, governance, regulations, etc. But if I request, now this is for all the esteemed panelists here, one key lesson from 2025 that each of you would carry into 2026, which one would that be?
So,
Who do you want to start with?
Well, I think let me start alphabetically. Maybe Anitesh goes first, then I think Shubhakanta, Saurabh, then I think Ravindra. Yeah.
I think, one key takeaway for me would be that control is becoming the new growth strategy. I think that is something we new for Indian private capital market and even otherwise. We saw P firms, foreign corporates all abandoning that passive minority stake mandate to getting into control transactions, which is basically say even up to 60% ownership. So I think even 2026 we'll see that kind of a thing where capital is not just going to be a support for management. Probably they are looking for steering wheels to in the M&A transactions now. So that is what for me is going to be watch out.
Yeah. So should I go next?
Yeah, please. Yeah.
Yeah. So I would say, Prasenjit, that look, I think to me the lesson is, and it's not a new lesson per se, I would say perhaps, is just persistence, right? And perseverance. I mean, when it comes to M&A deals, inevitably there will be curveballs along the way, right? There will be moments that test your resolve. There will be moments where it appears the deal might stall or fail, and your ability to sort of power through issues, evaluate ways to unknot hurdles, etc., continues to be as relevant today as ever. I mean, if anything, I would say more relevant, because the reality is, we live in a world today which is more uncertain. There is supply chain realignment at a global level. There is more protectionist policies, deglobalization tendencies in certain parts of the world. There are AI related uncertainties. There is geopolitical sort of uncertainty, or challenges in some parts of the world. So clearly a number of factors, which can impact M&A, which have clear implications for deal making, right? So I think the need therefore to be persistent, to be more adaptable, anticipate, retain optionalities, ability to pivot, etc., when needed. All of these become, I would almost say, base level expectations now when you are thinking about M&A, especially large M&As, multinational, multi-country M&As, etc., etc.
Very pertinent indeed. That's absolutely terrific. Saurabh, maybe I come to you and then we go to Ravindra.
Yes. I think mine is actually twofold. One, of course, is very clear that what to take off from what Ravindra had said very eloquently earlier, that regulation today, whichever side it is, regulation is no longer a tick box item. You need to factor it before and well before you actually get on to the specifics. So regulation and whether you are actually following the spirit of the law. I think all regulators have become the lesson clearly, if we've seen last year, is that all regulators have become very, very active, and but even the antitrust regulator has become very active, and they are going to go through the nitty-gritties, not to stall but to ensure an orderly marketplace. That's one. The second point, I think, again, is a forever lesson that do not get swayed by valuation. I think we've seen this earlier, and we are seeing it now. There have been a couple of high-profile deals last year, particularly in the edtech space, which have failed because of the valuation dissonance on either side. So I think that is another forever lesson, that don't get over ambitious with valuation, be realistic, and then things will go smoothly. I think these are the two key lessons.
Thank you. Yeah, Ravindra? Yeah.
Well, it's a challenge coming at the end, and I don't want to repeat what other speakers have said. So let me pull one out of a failed transaction and the key lesson that was learned. So I would say, many a times the deal is technically sound, but it still fails. And we have seen it, many of us have seen it play out in real time, and I have seen it in more recent times. This is a strategic joint venture between a global MNC and a strong Indian partner in a very capital incentive regulated sector. The deal struggled, but not on paper. It was in practice. And why did it struggle? Because there were differences in operating philosophy. There were issues which could have been addressed otherwise, but it couldn't. So nothing failed legally. No clause was breached. The governance framework was functioned exactly as drafted, but commercially, the momentum drained away. It drained away because the expectation mismatch was there between the global partner, who wanted one thing, and the Indian partner was used to another approach. Neither of the approach was wrong, but they were fundamentally very different. So I would say the lesson is that we keep relearning in M&A that it's not just about price, structure, or regulation. It's also about alignment of people and purpose. So sometimes, the true test of lawyering is building the contractual hedges, not just for legal risk, but also for the personalities of the parties involved. Prasanjit.
Thank you, Ravindra. I think with that, let's take some audience questions. We are around 15 odd minutes shy of concluding this webinar. So I think let me try and take as many questions I can, and whatever we can't, we will respond by email separately after the webinar is done. So I think the first question really, I think Shubhakanta, this is right down your alley, and maybe Anitesh, given all the data you have up your sleeves, I think, how did PE and VC behave in 2025? Were they net buyers, sellers, or recyclers of capital?
Yeah. So look, I think, the way I would answer it, Prasanjit, is look, from private equity perspective, we saw both, right? Meaning, we saw them sort of being very active, both in terms of investments as well as exits, right? I think on the investing side, like I mentioned, a bit earlier, we've obviously seen, strengthening of interest towards India, right? There are a lot of buyout shops which want to deploy more capital into India than what they've historically done, which obviously is clearly positive. There is obviously more sort of pools of capital headed from sovereign wealth fund, pension funds, right? So clearly from an investing perspective, you have more pools of capital that are headed India's way. But at the same time, there is meaningful focus on exits as LPs are demanding DPI, and frankly, as we've seen some funds struggle to raise new funds, right? Especially the ones who have sort of struggled to, let's say, have a good, strong track record of monetization and portfolio exits, right? So clearly you can see that there is emerging to be a bit of a linkage between just your success in returning money back to LPs and your ability to sort of raise the next fund, right? So I would say it's really sort of goes hand in hand, right? You need to be sort of active on both. I mean, there may be moments, or years or quarters, where one activity is more active, right? Investing or exits. But in general, I think you're going to have to sort of balance both, investments as well as sort of exits.
Nitesh?
No, I think, yeah. So, I mean, that is very interesting actually. So, I mean, by design, 2025 has seen a lot of recycling of capital that is happening, and I think that is very heartening to see also, because I mean, LPs have been shouting for different kinds of return matrices, in fact, in the market, and we have Indian market has been signed with that, right, from that. So 2025, like Subhakanta is mentioned, we saw a lot of recycling. Minority stakes were sold, large buyout stake have been taken, and a lot of, I think November itself saw more than $3 billion of exit in private, I think in public market, and I'd say different kind of block deals that we saw. So there is a lot of recycling of capital happening, which basically means that capital is going to go back to the LPs and new capital is going to get picked and deployed in the market. And specifically, the nature of transaction also is changing, right? So these exits are mostly minority stakes that people had. I mean, the B firms had from before, that is getting sold out, and now the newer transactions are mostly controlled transactions that they are getting into. So I think. Uh, I mean, no doubt, recycling of capital is what happened in 2025.
Right. I think the next question is also quite interesting. I think goes to the differentiating factor between strategic acquirers and financial sponsors. Maybe Shubhakant and Rabindra, you can supplement. What were the key differences in 2025 for strategic acquirers and financial sponsors, and what lessons does that hold for 2026?
Sure. Do you want me to start?
Yeah, Shubhakant, you first.
Yeah.
Yes.
So look, I think I would say that look, I mean, the difference, maybe just to answer the question, in the way I look at it, is probably strategic, activity. I think, which I think Saurabh mentioned earlier in the session, right, is clearly being driven by, let's say, specific capabilities that they want to acquire, specific gaps and white spaces that they want to fill, right? So it's fairly targeted M&A. It could be a billion-dollar M&A, but it's relatively targeted in terms of the industrial rationale it is setting out to achieve, right? Whereas, when it comes to private equity, I would say, look, the investing theme by definition for private equity can be much more broad-based, right? I think Anitesh, spoke pretty well, at the top of the call about sort of this whole platform creation, which has been a big theme in India. It's been a big theme the world over. Private equity in general, especially on the buyout side, platform is something that has kind of paid rich dividends, right? But there can be other sort of reasons or themes that private equity can adopt, right? So I'd say private equity by definition is going to be more broad-based in terms of themes and rationale for doing a deal, whereas with strategics, I think it's a little bit more focused around capabilities and specific white spaces and gaps. I think in terms of 2025, what we saw on that, look, I would say, if I were to bifurcate strategic activity into three segments, right, which is inbound activity, outbound activity, and domestic consolidation, clearly we saw a lot of domestic consolidation, as I think some of us have mentioned, in the call already, and that is a trend certainly we continue to see, going forward. We saw clearly more broad-based outbound trade activity, and I would say that happened across sectors, right? We saw it in industrials, we saw it in auto, we saw it in specialty chemicals, we saw it in certain aspects of tech where there was a need to acquire capabilities, etc. I think the inbound trade activity, while it continues to be visible, I would say it's probably stronger in certain sectors, right, as opposed to necessarily being very broad-based. For example, clearly we see a lot of inbound activity in financial services, right, both banking as well as non-banking. Clearly, we have seen a lot of inbound activity in financial services, both from Japanese strategics, from Middle Easterns, etc. We continue to see good interest in consumer sector, right, where essentially, strategics want to play in a larger way in the Indian market. But I think in certain other sectors, we have seen sort of more muted activity. I think one of the lessons perhaps has been that, while MNCs want to expand their presence in India, including through M&As, I mean, India, I think, like Anitesh mentioned very well, is a market which has relatively punchy valuations, right? So if I'm a strategic, which is an MNC, right, which is, let's say, trading in the home market at 12 to 15 times EBITDA, paying sort of 20 times or 25 times for an Indian asset can at times seem a little more daunting than, let's say, for a local listed acquirer who is trading at 30. Just financially, it just makes the equation a little easier, right? So there have been certain instances where MNCs have competed in auction processes, but eventually, a local, either a private equity fund or a local strategic has ended up winning the auction process. That's what I would say.
I'll supplement it. I will look at it slightly differently. What stood out for me last year wasn't just who was buying, but how differently the strategics and the financial sponsors executed in uncertainty. The strategics were willing to stretch on valuation where they had conviction on synergy, integration, and long-term platform value, while the sponsors remained disciplined on cash flow visibility, governance, downside protection, and exit optionality. In India, in particular, and we heard this from Anitesh right at the beginning, both converged around control deals rather than minority position, but outcomes were defined by execution style. So strategics moved deliberately for certainty, sponsors prioritized the clean process and tight risk allocation. Now looking forward, 2026, and since Shubhakanto has covered the segments, I will try to cover three themes, and I'll wear my lawyer lens while I list them down. One, the line between the strategic and sponsors are blurring. Two, front-end deal design around regulation and governance is becoming very, very decisive. And three, ultimately, the certainty of closing and quality of execution will matter more than the headline valuation. That will be my response. Prasanjit.
Right. Thank you very much. One last question, I think, before we head to the key takeaways poll and vote of thanks. I think maybe Anitesh, to you, and sort of a very quick one, because this is very relevant, the question here, because which sectors are most likely to drive M&A activity in 2026 and why? So a bit of a crystal ball grazing, but that's why we are here perhaps. So if you could just quickly share your thoughts on this one. Hot sectors in 2026.
I think one theme that is going to remain, say, very active for next, I think, 2-3 years is going to be, say, AI theme. So, I mean, there's going to be the reinvention play. Most of the IT services company and SaaS companies that operate out of India, they have to reinvent themselves. And I mean, they will have to go to any extent to make sure that they remain relevant in the market. So I think that theme is going to be very, very aggressively remain the central theme for next 2-3 years. And I hope they look at it from that perspective. Otherwise, I think even being relevant in the market will become tough. So that is one theme. Another, I think, energy transition is another theme that is going to remain very active. I think the decarbonization, the goals that we have for 2023, that 2030, that also is going to drive in that direction. So that is another theme. Next, healthcare, obviously India being such a large economy in terms of number of population and healthcare requirements that we have, and the platform play that is also coming up in the healthcare space. That is, I think, the third theme I would believe is going to remain very active in 2026. So these three, yeah, Sanjeev.
Sure of that?
Yeah, I think basically tech and AI, as we've discussed all through this program, the entire gap, filling up the gaps and the survival instinct of the tech and IT space will drive a lot of this. I am very, very bullish on the pharma and healthcare, particularly the healthcare part, because of the whole gap in terms of the number of beds and the hospitals which still exists in a country like India. You will see, in my view, many more such deals where bigger number of acquisitions will take place in that space. I wouldn't rule out manufacturing either, because my conversations with investment bankers also, sort of that they are getting a lot of interest on manufacturing now as that story begins to gradually play out back in India. So manufacturing also, and of course, the entire BFSI space will continue to be booming as banks and the financial sector. Don't forget that there's some consolidation going to happen within the public sector banking space as well. So that's also one theme which I would think BFSI will continue to be a very prominent play. So pharma, BFSI, IT, ITES, and AI are the key themes in my view. Pharma meaning healthcare.
Right. I think that's immensely helpful, Saurav. So I think before we head to the poll and people who may have tuned in a bit late, uh, to synthesize today's discussion in three, let's say, bullet points, I think first would be 2025 rewarded clarity on valuation, control, and governance. The second key point would be execution and regulatory anticipation mattered as much as pricing. And thirdly, which also holds true, I guess, for 2026, would be alignment between strategy, structure, and stakeholders, separated winners from the losers. And I would like to thank all our presenters for sharing their expertise and experience with us today with so much candor. I mean, you were simply outstanding. Thank you so much. Also, thanks to you, our dear audience, for your attention and your questions. I hope you found the webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you. After the webinar, as I mentioned it outside, we will send you a copy of the presentation which was projected today, along with the summary notes and the link to the webinar recording. You will also separately receive a request for your feedback on webinar. Please take the time to send us your feedback. That's also a very brief form, so should not take more than a minute to complete. If you're interested in in-house training or any other matters arising from this webinar, please do not hesitate to contact us. Our contact information, as you can see on the screen, is on this slide. Thank you for your attendance today, and we look forward to being with you again at the M&A Master Series. Thank you.
And thank you, Prasanjit, for rallying us together. The moderators should not be left behind. Thank you very much for all the preparation and doing this today.
Thank you for the kind. Thank you.
Thank you.
Thank you, everyone.
Thank you.
See you.